with. So this paper is joined with Tim Bollerslev from Duke and Yushan Tang from Rutgers. So Tim is in the audience, and Yushan, he will join in a few minutes. Okay. So now let me give you some motivation. Correlation is central to portfolio construction and risk management. Comparing with return and volatility forecasting, less is known about correlation forecasting. In this paper, we propose a novel framework to forecast the realized correlation RC with big data and machine learning. In our main feature sets, we have 25 features that are either hard-based, factor-driven, or exponential moving average features. In our robustness checks, we include another 150 additional features, which are interaction terms of one main feature and one form-linked dummy variable. Okay. So our main algorithm is LASSO because it's simple and very powerful. But in robustness check, we further considered rich, ENAT, PCR, and neural networks. Okay. Now let's preview the results quickly. Our benchmark model is a HAR model by Corsi 2009. That is to use lagged daily, weekly, and monthly realized correlation to forecast the 1 month ahead realized correlation. Relative to the HAR benchmark, our LASSO framework is able to improve out-of-sample R-square of realized correlation forecast by 10%, increase pairs trading strategy return from 3.6% to 9.3% per year based on the return convergence measure approximated by realized correlation forecast. Right. The literature has shown that the average realized correlation could predict the equity premium. We find that a 1 standard deviation increase in forecasted average realized correlation based on LASSO forecast could predict a rise in market access return of more than 18% per year. Further, our framework is able to produce ex-ante portfolio risk much closer to the realized risk, and we are able to reduce the risk of global minimum variance for GMA portfolios. Okay. So we contributed to the literature in different ways. First, our construction of the new feature sets specifically designed for correlation forecast that combines information from low-frequency market data and high-frequency market data and low-frequency fundamental data is new. Second, our use of sparsity encouraging fitting techniques to robustly exploit big data with many observations and features for more accurate large-scale correlation forecasting is new to the literature. Lastly, our illustration of the strong economic gains afforded in a wide range of practical applications, as importantly to our understanding of the new procedures and further underscores the value of better risk forecasts. Okay. Our paper is related to 3 strands of literature. The first literature is financial econometrics. In the early years, there are work that focus on modeling time-varying conditional correlations using Gauss type of models. Okay. And then parametric models are proposed to allow for asymmetric dynamic dependencies in conditional correlations. More recently, these multivariate Gauss type models have been extended to incorporate realized variation measures in the construction of more accurate forecasts. Distinct from existing literature, we focus on forecasting realized correlation measures constructed from intraday high-frequency data. By doing so, we allow for more flexible dynamics and a much wider set of predictors. Okay. Our paper is also related to the machine learning in finance literature. Okay. As we know, there is a growing existing literature devoted to return prediction using machine learning. Okay. There is also a relatively small literature on machine learning algorithms for risk management. We differ from existing studies in 2 important dimensions. First, our work from existing studies, our work focuses on specifically designed and economically motivated new feature sets and a deliberately chosen fitting technique for building reliable forecasting models. Secondly, rather than focusing on pure statistical assessments of the correlation predictions, we demonstrate the economic value of the new procedures for a range of practical financial applications. Our work is also related to the strand of literature on stronger co-movements among certain types of stocks. The literature has shown that S&P 500 index constitutes firms with similar institutional ownership, firms with headquarters in the same geographical location, or firms with similar analyst coverage. They tend to co-move stronger together. In contrast to those studies, which primarily focus on causal relations between firm linkages and asset price movements, we focus explicitly on the prediction of future stock return correlations. And we show empirically that firm links provide limited predictive power over that afforded by our newly designed features. Now let me introduce to you our data and variables. So the covariance matrix, RCOV, can be decomposed into three components. So the first and last components are diagonal matrix of volatilities. The middle component is a correlation matrix. Okay. Later, I'm going to show that realized correlation and realized volatility, they tend to have different dynamics. So we're going to focus RV and RC separately. The main focus of this paper is to predict realized correlation RC. And the realized volatility is modeled by univariate HAR models. And more sophisticated machine learning-based method to forecast volatility can be found in my other work with Yushan. So the response variable Y is the 1 month ahead realized correlations for all pairs of the more than 400 S&P 500 stocks with full history over 2003 and 2020. And we use 15 million mid-code prices from the Tang database to estimate realized correlation. Choice of stock universe, sampling frequency, and mid-code data effectively mitigate non-synchronous prices and beta bounce effects that could induce downward bias in realized correlation estimates. Okay, so let's take a quick look at the 12-month moving average of realized correlation in blue and realized variance in orange color. As you can see, realized variance and realized correlation, they exhibit very different dynamic dependencies, with realized correlation in blue being relatively more stable, which justifies our choice of modeling RV and RC separately. Okay. And we further plot the histogram of realized correlations across different stock pairs and over time. Although the time series of realized correlations appear relatively stable, the unconditional distribution still reveals non-trivial variation. Okay. Then let's look at the feature sets. So we have 3 different types of features: the HAR-based features, factor-driven features, and exponential moving average features. One of our major contributions is to construct a large and novel feature set for correlation prediction. To the best of our knowledge, we are the first to use exponential moving average terms with sector risk to predict correlation. We're the first to use observable form characteristics to back out factor-driven realized features instead of constructing high-frequency factors. And lastly, we're also the first to combine features from econometrics, statistics, and finance literature. Okay. So let's first zoom into the HAR-based features. We extend the HAR model by Corsi 2009 and the semi-HAR model by Patton and Shepard 2015 for volatility modeling to correlation forecasting. So the first 3 features, RCD, RCW, and RCM, are lagged daily, weekly, and monthly realized correlations constructed using 15-minute mid-code returns. We denote the model with those 3 predictors as the HAR model. And we further consider 3 summing measures: RCD negative, RCW negative, RCM negative, which are lagged daily, weekly, and monthly realized negative summing correlation constructed using negative returns only. So the previous literature has shown that those summing realized features, they tend to contain information and can help improve portfolio risk forecast. Okay. And we denote the model that includes the 3 HAR terms and the 3 semi-HAR terms as a semi-HAR model. And our second type of features are factor-driven features. Let's assume returns on n assets are driven by k common factors. So R is n by 1, factor F is k by 1, and the factor exposure matrix L is n by k. Okay? Then the covariance of return can be decomposed into the sum of 2 components. So the first component is a covariance of returns driven by common factors, and the second component, in a perfect world, should be diagonal because the error terms should have 0 correlation. Okay? So we're going to use the first component plus the diagonal of the second component to denote the factor-driven covariance matrix component. Okay? And our factor-driven realized features are the off-diagonal elements from the correlation matrix of the sum, okay, which can be considered as denoised lagged realized correlation. So the difference between those factor-driven realized features and the previous features, the HAR feature, are that we dropped the diagonal the off-diagonal elements in the covariance of the idiosyncratic error terms. So we denoised those features. Then the question is, how do we obtain the first component? So the existing method is to construct high frequency factors using 15-meter return. Then we calculate the covariance matrix of the factors. We adopt a new approach. We're going to use low frequency from characteristics and the covariance of returns to back out this entire component, which is computationally more efficient. Okay. So let's dig into deeper and how we do it. So we're going to use observable characteristics as factor loadings L to back out F, and this follows from a French 2020. So for example, if we have observable size characteristic for different firms, then we can consider size as exposure to the underlying size factor, etc. So again, return has this common factor structure. Then F can be expressed as a function of L and R. Okay, then we can show a simple math. The first component will still be expressed as a function of the characteristic exposure. So the exposure matrix consists of characteristics. So it's L and the function of the covariance of returns. Okay. Then the next step is to use the daily, weekly, and monthly realized correlations to back out the entire component L times covariance of factor times L transpose at 3 different speeds, producing 3 factor-driven realized features denoted by FRCD, FRCW, and FRCM. And empirically, we can use 15 characteristics to construct L. The 15 characteristics including 11 mispricing anomalies from Stumble et al. 2012, plus kappa and beta, size, book to market, and reversal. And we refer to the model based on the previous 6 realized features, the 3 HAR features plus the 3 semi-HAR features, along with the 3 factor-driven realized features as a semi-HAR factor model. Okay. And the third type of features, exponential moving average features. So first we have the exponential moving average of the daily realized correlation and the negative semi-correlations with half-life between 1 day and 1 quarter. So we have 8 exponential moving average features. And we also consider another 8 exponential moving average of within sector average realized correlations to exploit the stronger within sector correlation. Okay, so for those set of features, they are non-zero if the 2 stocks they belong to the same sector, and they're set to equal to 0 if the 2 stocks they belong to different sectors. Okay, and we denote the semi-HAR F model without above EMA features as our semi-HAR F exponential model. I know the name is a bit long, but you can consider this as the OS model that includes all 25 features we proposed. Okay, so I'm going to skip the feature descriptive statistics in the interest of time. Now let's look at the estimation methodology. So in parallel to other machine learning algorithms, LASSO requires a validation set for tuning its hyperparameter. Okay. We adopt a training, validation, and testing scheme. Okay. We rely on pooled models based on panel data for out-stock pairs. That's because we find that the correlations, they share a common dynamic structures across different pairs. Our training set consists of data from year T-4 to year T-1. Our validation set consists of data in year T, and our testing set consists of data in year T+1. We refit the models every year by rolling the training, validation, and testing sets 1 year forward. By doing so, we allow the features selected by LASSO to dynamically enter and exit the prediction models based on changing market conditions. Okay. So the simple linear combinations of different features is denoted by fx theta. Okay. So unlike OLS, LASSO estimates theta through a panelized L1 loss function. Okay. So besides the regular OS objective function, we also have another penalty term, that is lambda times the absolute value of the theta coefficients. Okay? And lambda is a shrinkage parameter that controls the amount of shrinkage or degree of penalty. When lambda is 0, we collapse back to the standard OS, and when lambda is positive, then we can perform feature selection. Empirically, features are normalized by training set mean and standard deviation to have comparable magnitudes for meaningful feature selection. Okay. Now let's look into the out-of-sample forecasting performance of our LASSO-based model. So the out-of-sample R-score relative to the HAR model is constructed as follows. So in the numerator, so RCM denotes the monthly realized correlation. This is a true correlation, okay? And RC hat M theta is the predicted realized correlation from model theta. So in the bottom, RC M hat HAR, this is a HAR model predicted realized correlation. So the higher the out of sample R score, the better theta performs over the HAR model. Okay, so we have two different versions of the out of sample R score. When the omega is set equal to 1, then it's equal weighted. When omega is a product of market caps of the two stock pair, then it's the value weighted version of the out of sample R score. Again, a positive out of sample R score indicates that model theta achieves smaller out of sample prediction mean squared errors than the HAR model. Okay. So we further compute and modify the Diebold and the Mariano test for pairwise comparison of two models. So this test statistic is based on the difference in the out-of-sample squared error losses. Again, we have equal weighted and value weighted versions. Okay. Now let's first look at the relative performance of the semi-HAR model relative to the HAR model. Again, in the HAR model, we have only three predictors: the lag, the realized daily, weekly, and the monthly realized correlation. The semi-HAR model has three additional semi-HAR terms relative to the HAR model. You can see that the semi-HAR model can slightly improve over the HAR model with equal weighted R score of 0.22% and a value weighted R score of 0.11%. Okay. Then let's further add the three factor-driven correlation features into the model, which is called the semi-HAR F model. Okay. Again, you can see that the three factor-driven features can further improve over the previous model with out-of-sample R score equal to 1.7% and 1.3% for the equal weighted and value weighted versions. And next, we're gonna throw in the 16 additional exponential moving average terms. And you can see that the exponential moving average terms are very crucial in improving the model performance. The out-of-sample R score jumped to 9.8% for the equal weighted version and to 7.3% for the value weighted version. Again, this is the OS model with all 25 features. Your other question may be like, do we need all 25 features? What if we dynamically select the features? Okay, then let's look at the LASSO performance. Again, we include all 25 main features, but we allow the features to dynamically enter and update into the model over time. As you can see, LASSO can further improve over OS with equal weighted R score of 10.16% and 8.05%. One question you may ask is that, if we look at the relative performance between OIS in 3 and the LASSO in 4, the improvement may not seem quite big. But one benefit of using LASSO is that LASSO is able to produce, a correct matrix forecast that are mostly positive definite. This is very important if we want to construct the GMV portfolios, global mean variance portfolios, because we need the metrics to be invertible. However, the covariance forecast produced by the OS is often not positive definite. Okay. All right. And besides the auto-sample R-score, we further perform DM test statistics to compare model performance. Let's focus on the last row. Okay. So the T statistics compares model in the row and the model in the column. A positive number indicates the row model outperformed the column model. You can see that LASSO can significantly outperform the other models. Okay. So this is the equal weighted DM T statistic, and the conclusion is same for the value weighted DM T statistics.
So can I break in with a question here? So there's a question in the chat from Dima. And the question is, I wonder whether correlation based on whether daily correlation is the most relevant dependent variable from the perspective of applications, or should we care about, for example, the correlation over a monthly horizon, for example?
I think that's a very good question. So in this paper, we mainly focus on predicting monthly correlation, but we can change the dependent variable to daily and see how the model would perform. That is something we can definitely do. But I would say that for monthly, it's important because for portfolio construction, trading strategies, then monthly is the usual horizon due to transaction cost. But we can definitely extend the forecasting horizon to daily and weekly, just like what we did for the volatility paper. In the volatility paper, we consider the daily, weekly, monthly, and the quarterly forecasting horizon. Okay. All right. And then you may wonder how many features are selected by LASSO. So on average, 10 features out of 25 features are selected. Okay. So in the plot here, we presented the row denotes the 25 main features, and the bottom denotes the year in out of sample testing period. So as you can see that some features such as the exponential moving average realized correlation feature with a half-life of a quarter is constantly selected. It's very important, always stay in the model. Okay? And then the realized correlation feature at monthly frequency is also selected most of the years. Okay, and we have other quite important features. But in several long-term predictors are constantly selected over time, and different short-term signals enter and exit the models. Very interestingly, the model is most sparse for year 2010. You can see that in this year, only 4 predictors are kept in the model. And we suspect this is due to the changing market conditions, because we have the financial crisis years before, and then the model dynamic changes to adapt to the changing market conditions. Okay, so this is one nice feature that the OS model cannot have, and later we can show that in robust check our model performs really well during the crisis period. Okay. Now let's look at the empirical applications. Okay, so should I ask the question or later?
I mean, if you let me, I would like to ask. I mean, you said that several long-term predictors. I mean, could you clarify a little bit what are those?
Sure.
Yeah.
Most important feature is the exponential moving average feature with half-life of quarter
Of course.
or quarter.
All right.
The feature with the longest half-life. And the next important feature is the realized correlation feature at the monthly frequency. It is selected in 10 out of 13 years. And the next important features are factor-driven realized features at the daily frequency, at the weekly frequency, and the exponential sector specific realized correlation at daily frequency. Okay. And another important feature is exponential realized correlation features at monthly frequency selected in 7 out of 13 years.
And I have another question as well. This short term, I mean, do you mean sudden spikes or very rare events, or what type of short-term signals? I mean, I couldn't also catch that.
Okay, so some short signals is that like either you only use the past daily or weekly information, or you put more weight in those recent observations to construct the predictor. That's what we call the short-term signals. And long-term signals are those like, for example, the exponential terms, we use hundreds of observations to construct those terms. So those like smooth average features of observations during a much longer historical period.
All right, thank you so much.
All right, now let's look at the empirical applications. Okay. So we see that we have seen the improvements in out-of-sample R-squared based on our LASSO framework. The open question is, can statistical improvements translate into economic gains? And next, we evaluate the economic significance by considering 4 practical applications, including an augmented pairs trading strategy, the equity premium prediction, risk targeting of long-short portfolios, and global minimum variance portfolio construction. Okay. So the first application, pairs trading, bets on price convergence. Okay. The main idea is very simple. Stocks with return above or below its pair portfolio are likely to be overvalued or undervalued, then the price will converge. Okay. So we construct the return divergence measure based on the paper by Chen et al. 2016. It is the return difference between stock I and its pair portfolio. So the second term is the excess return of stock I, and the first term is the excess return of its pair portfolio. The beta coefficient is the regression coefficient from regressing stock I's returns on its pair portfolio returns using daily data in the previous 1 year to make sure that those two returns are comparable in magnitude. Okay. Then we define the top 20 stocks with the highest 1 year historical correlation with stock I as its pairs. Okay. One key implicit assumption behind the above pairs trading strategy is the persistence of correlation. So to improve the strategy performance, we can explicitly incorporate correlation predictions into the portfolio construction. Specifically, we can measure delta RC theta, which is the predicted realized correlation between a stock I and its pair based on model theta, and the historical realized historical correlation between stock I and its pair portfolio. Okay, so this difference captures the persistence of correlations. So the higher the difference, the more likely that a stock's price will converge to its pair portfolio in the future based on model theta. Okay. So what are we going to do to incorporate the information into pairs trading strategy is that we can keep the subset of stocks in the highest delta RC theta quintile. So those stocks would be more likely to converge to its pair portfolio based on model prediction. Then we form pairs trading strategy with this subset of stocks instead. Okay. So what I'm going to do next is that I'm going to first demonstrate the failure of traditional pairs trading. Okay. So if we use the entire stock universe without considering the persistence of correlation, and pairs trading no longer works in the most recent decades, and then I'm going to show how a better correlation forecast could enhance pairs trading strategy. All right. Now let's look at the equal weighted portfolios sorted by return divergence. So the unconditional row presents the results of the pairs trading portfolio formed by the entire stock universe. So you can see that the spread is only 1.15% per year and insignificant. And if we use the HAR model to predict the correlation between the stock and its pair, and then form a pairs trading strategy based on this subset of stocks, and then the spread can increase to 3.6% per year, but still insignificant. However, if we select the subset of stocks with the highest convergence probability based on our LASSO framework, then the pairs trading strategy return can be augmented into 9.34% per year and is significant. Okay, then let's further move on to the value-weighted portfolio sorted by return divergence. Again, the unconditional strategy formed using the entire stock universe does not work. The spread is even negative. If we use a HAR model to predict the correlation persistence and then choose a subset of stocks to form pairs trading strategy, the spread is 6.1% per year, but still not significant. However, based on our LASSO framework, okay, then the strategy spread can be improved to 8.85% and is highly significant. Okay. And to make sure that the strategy works, we further run Fama-Max regressions controlling for beta size, bookmark ratio, and momentum. As you can see that after controlling for those characteristics, the return difference measure still can significantly predict the future returns. If we use LASSO to select those stocks with the highest return convergence probability, and again, the unconditional strategy does not work. So this is not does not contradict with the original paper by Chen et al. Because in their paper, their sample stopped near the financial crisis and showed that the pairs trading strategy does not work very well near the end of their sample period. So their sample starts from like 1926, but we show that by combining pairs trading with our correlation prediction measure, then we can still make pairs trading work and highly profitable. Okay. All right, and I want to mention that the strategy is balanced monthly, so it can definitely survive transaction cost. And to make sure the strategy works over time, we further plot the cumulative profits of the equal-weighted strategy. Okay, in the bottom, we have the unconditional strategy without using correlation prediction. You can say that the unconditional strategy does not work at all. Okay, and if we use HAR model to predict correlation, then this augmented trading strategy works better than the conditional version, but still not that significant. And if we use LASSO to predict correlation, this portfolio performed the best. Okay. And then let's further show the value-weighted strategy performance difference, which shows even more clear contract. Okay, and you can see the HAR model, although it generates like high spread on average, but because of the high volatility, cumulative profit is not very high. Okay? However, our LASSO based pairs trading strategy works extremely well. All right. And the second application is the equity premium prediction. The Polite and Wilson 2010 shows that average correlation among stocks manifests aggregate systematic risks and therefore can predict the future market returns. Okay, so we compute the average correlation as follows. We calculate the correlation across all the pairs, and we have two different weights, either equal weights and or value weights. So in the original paper, the average lagged pairwise correlation is used to approximate the expected future average correlation. And by the same logic, the use of superior correlation predictions should result in stronger return predictor because they can better approximate the expected future average correlation. And we further include the 8 commonly used macroeconomic predictors from Welsh and Goyle as controls. So let's first look at the prediction based on equal weighted average correlation. Okay, so RC is the average correlation based on historical correlation. similar to the original paper. You can see that does not work at all during our sample period. And if we use a HAR model to predict correlation and construct the predictor, it can improve, but still not significant. However, if we use our LASSO framework to predict correlation and construct the predictor, then the predictor remains significant as an individual predictor, and also is highly significant after controlling for other well-known equity premium predictors. Okay. And then we also look at the predictor constructed using value-weighted average correlations. Again, if we form predictor using historical correlation does not work well, so HAR can slightly improve but not significant. And our LASSO-based value-weighted average correlation generates significant prediction results. Okay. Now let's move on to the third prediction, the third application, which is risk targeting. So we consider a portfolio manager who allocates her funds into unrisky assets based on a long-short trading strategy. So specifically, we set portfolio weight for stock I to 1 if the stock is in the long leg of the strategy, and we set it equal to -1 if the stock is in the short leg of the strategy. Okay? And we use a simple HAR model for volatility prediction. Okay. So we can average the risk targeting ratios across testing samples to get this average ratio measure. So the numerator is the predicted long-short portfolio risk based on model theta, and the denominator is the realized portfolio risk. Okay. Then we compute the average over time. So we have an average ratio based on model theta for each of the long-short strategies. We consider 15 different long-short strategies in total. And more accurate correlation forecast should produce average risk targeting ratio much closer to 1. Okay. Now let's look at the results. Okay. So in the results, we compare the HAR model performance versus LASSO performance. So HAR model is the light blue bar on top, and the LASSO performance, the dark blue bar with the line in the bottom. Okay, we also have the 95% confidence interval. You can see interestingly, the HAR model seems to under-predict the long-short portfolio risk for most strategies here. Okay, and out of the 15 strategies, only the first strategy is the target ratio of 1 falls in the 95% confidence interval. However, for our LASSO-based model, the risk targeting ratios are much closer to 1. Out of the 15 strategies, 6 strategies has a 95 confidence interval covering the targeting ratio equal to 1. So they performs much better based on our LASSO-based model. And in our robustness check, we further consider another 15 long-short strategies, and the results remain the same. Okay. All right, then let's take a look at our last application. Okay, the global minimum variance portfolio. So the global minimum variance portfolio, or the GMA portfolio, is often used for evaluating covariance matrix forecasts. The portfolio weights only depend on the covariance matrix, so it offers clean comparison. And another nice feature of the GMA portfolio is that it empirically tends to achieve higher out-of-sample Sharpe ratios than the mean variance efficient portfolio. So we will first calculate optimal portfolio weight vector, and then compare the portfolio returns, realized portfolio risks, portfolio Sharpe ratios, and the realized utility gains from switching forecasting models. Let's look at the results. So we compare the HAR model and our LASSO model. We report mean return, standard deviation, Sharpe ratio, and the utility gain from switching between HAR model and the LASSO model. Okay, so let's first look at the mean return. HAR generates a mean return of 10.27%, and LASSO delivers a higher mean return of 10.9%. In terms of standard deviation, HAR generates a standard deviation of 36.4%, whereas LASSO produces a lower standard deviation of 34.49%. Okay, and thus LASSO delivers a higher Sharpe ratio of 0.48 versus 0.36 generated by HAR. Okay, then let's look at the utility gain. If we switch from the HAR model to the LASSO model, the utility gain based on risk version coefficient of 2 is equal to 0.77% and becomes higher at 0.98% if the risk version coefficient is 5, and is even higher at 1.37% when the risk version coefficient is equal to 10. Okay. Then we further plot the GMA portfolio risk based on the LASSO model and the HAR model. You can see that most of the data points above the 45-degree line, meaning that our LASSO model can produce portfolio with lower risk than the HAR model, right? So the last application is the beta neutral GMA portfolio. We consider a beta neutral GMA portfolio following Kaufman et al. 2016, okay, which is that we augmented the traditional GMA optimization problem with one more additional constraint that set the portfolio beta equals 0. Okay, and here M denotes the n/1 vector of firm market capitalization normalized to sum to unity. Then we're going to compare returns, risks, Sharpe ratios, and the realized betas of the resulting beta neutral GMA portfolios. Okay, like before, we first compare the mean return standard deviation and Sharpe ratio. You can see that LASSO generates higher mean, lower standard deviation, and higher Sharpe ratio relative to HAR. And more importantly, the realized beta generated by LASSO is much closer to 0 and insignificant. Okay. And the utility gain from switching from HAR to LASSO is even higher. It ranges from 1.8% to 6%, depending on different risk version coefficients. And next, we also plot the realized beta based on HAR and LASSO over time. Okay. So the one based on HAR is in blue. You can see that the beta has a downward bias. Okay. And for the beta generated by LASSO in orange, most of the beta estimates are much closer to the target of 0. Right. So those are the applications, and we further conducted a lot of robustness checks. Okay. So the first robustness check is to estimate the model performance over different subsample periods. You can see that LASSO performs really well over time, and especially during the financial crisis period. The gain versus the OAS is close to 1%, right? And the value weighted gain is even higher. So the relative out of sample R square based on the OAS is 3.6% during the crisis. And for LASSO is more than 2% higher. Okay, so
Sophia, just quick clarifying question. These numbers were kind of nested in the previous numbers, right? In the sense that the previous analysis, you were training on 4 years, testing on the next year, and rolling. And here you're just presenting the sub results.
Yeah, it's a sub results. This is a sub results for different out of sample periods. The previous year's result is just that we average across all 3 sub periods.
Thank you.
But the gain is especially more from OS to LASSO during the financial crisis period, because we need to change the model more.
So one other thing, it would be good if you could finish up in about 5 minutes. So you might want to be selective in presenting the robustness analysis.
Yeah, of course, I will finish in 5 minutes.
Okay.
And we further perform out of sample prediction during the peak of the COVID period. You can see that again, HAR seems to underestimate the model because the data points in blue are kind of further deviated from the 45-degree line, but the LASSO generates predicted realized correlation much closer to the realized correlation. You can see that most of the orange data points are much closer to the 45-degree lines. Right? And we also considered alternative features and machine learning techniques. We further consider 6 additional economically motivated firm linkage variables, including distance between 2 firms' headquarters, text-based network industry classifications from Howard and Phillips data library, the industry supply chain dependence, common analyst coverage, common active mutual fund ownership, common passive mutual fund ownership. So after training firm variables into simple dummies using medians as a cutoff, we construct the two alternative feature sets. Our original 25 features plus the 6 per-link dummies, or the original 25 features plus 150 additional features, obtained by interacting each of the original features with the 6 dummy variables. We further consider the use of alternative machine learning algorithms, including rich, ENet, PCR, and feed-forward neural networks. Okay, so let's first look at LASSO, the baseline results. If we further enlarge the feature sets, the out-of-sample R-square slightly increases, but not much. Okay, so rich underperforms LASSO. ENet also slightly underperforms LASSO. For PCR, it outperforms LASSO using the original feature set, but underperforms when the feature set becomes large. For FNN, it underperforms LASSO across all different feature sets, and the conclusion for valid version is quite similar. All right, that justifies our choice of using the original 25 feature sets and sticking to LASSO as the main algorithm. All right, now, so let me conclude. In this paper, we use big data and machine learning to forecast realized correlation. In terms of feature engineering, we build a large and novel feature set based on insights from various literature. For the scale of experiments, it is large in terms of stock universe and feature set. For out-of-sample performance, we're able to improve out-of-sample R-square, triple pairs, trading strategy profit, enhance market equity premium prediction, and produce ex-ante portfolio risk much closer to the realized risk. And lastly, we're able to reduce the risk of the GMA portfolios. And the same ideas and techniques could also be used in the construction of forecasting models for other commonly used risk measures, including measures of precision and factor risk exposures. Oh, that's all. Thank you so much for the opportunity and for the questions.
All right, so Sophia, thank you very much. There were a couple questions in the chat that I put off because I didn't think they needed to be answered at the time. But actually, and you actually partially answered them in your robustness checks. But anyway, I'll read the questions now. So how would LASSO performance compare to classical model selection criteria such as BIC or AIC? And also whether using more flexible methods such as boosting trees or random forest would further improve performance.
Okay, so I believe that our LASSO model, the feature selection, we also use the AIC and BIC as like selection criteria. And for the tree-based models, I have been talking with Tim, and I think we wanted to keep the paper as close as possible to existing financial econometrics literature. The existing literature mainly focuses on linear models, which is more interpretable and easy to follow. And so we consider neural network which is nonlinear, and we can definitely try tree-based models. So one reason we didn't try yet because we use the panel data, which is very large. We have more than 400 stocks. All the pairs is, we take a square, so is that kind of magnitude, and so the training is kind of low. But if the interest is high, we can definitely try a tree-based model. But one issue with tree-based model is the interpretability. So to allow for the feature interaction in the robustness check, as we just saw, we also consider the interaction between our main feature and the different firm dummies. We find the interaction does not improve the model performance. In some cases, it's gonna make the performance even worse. But we can, down the road, we can definitely try different tree-based models.
Good. So actually now, we invite anyone who has a question or a comment to please feel free to unmute yourself and ask your question or make your comment using the microphone.
Can I maybe start and jump in? So the main idea of the paper is to make people to switch from the traditional models to this LASSO model, or is there some way to patch the existing models based on your results to make them work better?
Actually, thank you Dimitri, for the excellent question. So actually, our current model is based on existing models. For example, the HAR models have been used to predict the volatility, and we just convert them to the correlation like features. And then Tim has a 2018 RFS paper which uses potential moving average features to predict predict volatility. And we construct a similar exponential moving average version of the correlation. So a lot of features already based on existing models, and we just combine them all together. And we've also considered a lot of like firm link based measures, which are more often used in the finance literature. And we found that in terms of prediction performance, they don't help much, but they can definitely help with the causal interpretation of why firms can move with each other. That said, our current model is definitely based on existing models, but we will show that if we combine the knowledge from existing model with machine learning, then the model is going to perform. We can definitely improve the forecasting performance.
Sophia, a quick clarifying question, and then another one afterward. So when you do the portfolio analysis, you said that you were rebalancing monthly, right?
Yes.
Yes, but you are not training monthly. You're just relying on the beginning of the year training and then just updating the signals as the year unfolds. Is that correct?
Yeah, so we train validate and forecast so we don't train every month, we train every year.
Yeah, so that's what I thought I had understood. I'm going back to that nice figure about the selected features. It's figure 3 in your paper, right? So you showed us that that figure where, for instance, in 2010 you didn't have that many features, and a lot of the features that you keep hitting back on are kind of these long horizon features. And I was wondering if it's kind of mechanical, or if it's not mechanical, but if it's related to the horizon you're using, or if it's actually kind of an economic message that you're sending us. And so the reason I was asking about the monthly is, would it be that time consuming? I know it would be kind of 12 times more time consuming, but is it kind of doable to retrain monthly? And in that case, could you run the same kind of analysis as the one you had in figure 3, but running monthly and then doing exactly the same thing, but on weekly data rather than monthly? Now you're forecasting 12 months into the future, you could forecast 52 weeks or 4 weeks. If the kind of the lower frequency correlation signals were better than the higher frequency ones, even shortening the horizon prediction, then that would tell you something about the noisiness of the high frequency correlation measures, right?
Yeah, thank you, Christian, for the excellent questions. So right now we're based on 15-minute mid-code data. This is, also based on Tim's most recent work on correlation covariance forecasts. So it's, it's based on existing measures. So we're not that worried about the microstructure noise at this frequency. And we also have a signature plot showing that at this frequency, the correlation estimate is kind of is stabilized. We're not worried about the downward bias much. But as you said, potentially we can switch to different frequency. For example, maybe we can use we can definitely try different frequency, and we can also update the model more frequently. So that will definitely increase training time a lot. But I think, as you said, it might improve the performance of the model because we are updating the model using most fresh information. So I suspect that the result will be even better than what we have right now.
Yeah, just to clarify, I'm not worried about the way you're measuring the daily realized covariance, for instance. I'm just wondering if the model is not telling you that looking at daily correlations is not something that clever, in the sense that maybe correlations vary a lot at lower horizons, but what really matters economically are kind of longer.
Okay. I understand what you meant. So you meant that most of our current features are constructed based on daily correlations. We just use different ways. What if we switch to weekly, and what if we predict even longer horizon of correlation? I think that would be interesting. That'll be interesting, and that's something we can definitely look into. Thank you so much.
May I actually further elaborate?
Yeah, please.
I really enjoyed actually your presentation. Thank you for your time. I really enjoyed it. I mean, I could see actually your study is based on mostly pairs trading actually in all essence, right?
One application is pair trading.
Yeah. Actually, I'm not sure if you are familiar. There is an option actually mimics pairs trading to some extent. Have you actually checked them out? Quotient options actually, they are written to, mimic pairs trading strategy rather than getting engaged in a pairs you just buy or sell quotient options. And in case of volatility and through calibration, actually such options might give you some further ideas.
Yeah,
just wanted to actually add that.
Yeah, that's an interesting question. We never thought about that. If we can gather the data easily, we can definitely take a close look, and that's the new benchmark.
I mean, I'm not sure if you could easily find the data. They are not easy to find actually, but I mean, if you could, I mean, through calibration, maybe you could actually have some really nice comparison with your estimation.
Yeah. Thank you.
No further comments. Thank you.
Thanks a lot.
Any other questions or comments? Last chance to ask Sophia. Last chance to tell her she's wrong.
You know very well, Neil, that our people are very, very polite. So our guests wouldn't do that. So Sophia, thank you so much for this presentation. It was very interesting. We are looking forward to seeing how the paper would unfold in the next couple of months.